All right, now we're going to get into trends and trend transition. As I always like to keep in mind about everything, don't find the trend. Kara Swisher. So true. So true. So true. It was actually hard to find a quote that said that, because for the most part, trends have to do with like clothing and fashion and other kind of crap, which you shouldn't follow. It's kind of, the successful mindset there is to blaze your own path, but this is a bit different. So in this aspect, we want to follow the trend. The trend is our friend. Trends. No, we are not talking about the 80s making a comeback. A stock trend, by my definition, is a consistent move in a particular direction, either higher or lower. I will refer to them as uptrends and downtrends moving forward. This doesn't mean that a stock is going up every day without any down days. Think of it as a progressive march in one direction. If you take 5 steps forward, 3 steps backwards, then another 5 forward, your progress is still forward even though there was a setback along the way. Does that make sense? A stock will tend to persist. A stock will tend to persist in the direction it has already been moving in. This is where the slogans, "The trend is your friend" or "Trust the trend" comes from. I can't overemphasize the importance of this. The easiest money to be made will always be trading with the trend and not against it. Let's look at some examples of each. Uptrends. Trends are like people, all different shapes and sizes, but still alike at the same time. All uptrends generally have a stair-step pattern higher, a combination of higher highs and higher lows. So here you see a few examples. I mean, it's pretty easy to see and pretty easy to understand, So an uptrend, it's lower down here to the left and it's higher up here to the right. And you can kind of see how the stair-step pattern works. There are points where, it goes straight up, but that's not typical. That's generally where some sort of greed or exuberance happens and things get overheated, like we talked about earlier. And then this is often what you see on the other side of that, where it comes down as things settle in. But you can draw a line right in the middle of it, and you can see how there's almost like this area, like this level of value that it trades through, right? So we're going to use that to our advantage in the future, and we'll be using that to trade with. Here you see an example of what I refer to as the higher highs and higher lows. So you have a low here, and you have a higher high than the previous high, then a higher low than the previous low. And again, higher high, higher low, higher high, higher low, higher high, low, high. Okay, these are characteristics of an uptrend. Now we have downtrends. I like to say that stocks take the steps up and the elevator down. Fear and panic are generally stronger emotions than greed, and I think that represents what we tend to see during trends lower pretty well. A combination of lower lows and lower highs. So this is essentially the opposite. Oftentimes you will see when selling starts to happen, especially when it's very, very big sell-off, like when you have the stock market, when the stock market crashes, right? They call it a crash for a reason. It's not usually called a crash or have any kind of slick names for it whenever it's going up. The crash is because there is an oh crap moment or several oh crap moments or oh crap moments that happen over a long time. That is where people are panicking and they just want to get out and they don't care. That's not really what happens when the market's going up and people are making money. So you can see it's a bit steeper here. So, but again, same stair step lower. You could draw a line through the center of it and you can see how it kind of gyrates around that. Same here. And here we have the same deal, or the opposite of the uptrend. You've got the lower lows and the lower high, low, high, low, high, low. Right. So if you have an uptrend and a downtrend, there has to be times where it makes that transition from up to down, right? So stocks go through periods of trending up, trending down, and periods of transition in between, which is what I refer to as non-directional, sideways, or consolidation. Sometimes the change in trend is abrupt from higher to lower or vice versa, which is what you see here. Sometimes a trend needs to rest and consolidate before it moves higher or lower. Sometimes a stock will change direction over a longer period of time as the trend changes direction from higher to lower or vice versa. No matter the reason, it is something to become familiar with, as there is little opportunity to make money in this environment. To be able to avoid it, you must be able to recognize it. So as I mentioned earlier about the counter trend trading that I was doing, that would essentially be saying that I think that this stock should be going lower, so I'm going to start selling it here, and then here, and then here, and then here, and then ultimately losing enough money to where you give up on it, and then it starts to turn in your favor instead of waiting for it to turn in your favor before you start putting money on the line, right? Which is the smart thing to do. So I figured I'd throw that in there to help to circle back and also kind of complete that thought in a visual way. But here you see a trend that was going up, seemingly fine, everything's good, and then boom, it's just broken down and it just reverses. There are several reasons for this, but that's common. Here you see this kind of trend, so that would be one type of trend transition. Another one is here, where you see it, what I call a consolidation, sideways, non-directional. They all kind of, different words for the same thing here. But essentially the stock market or this stock is not going anywhere. It's moving sideways for an extended period of time. We can see here that it has broken out higher. And so this is the transition. This is the transition from a non-directional state to a trending state. And then we can see here, based on what we've learned about the uptrend, that an uptrend has now taken place. All right, time frames. There are different time frames, generally 1 minute up to 1 month, and a mix of everything in between. The more advanced platforms like Sierra Chart can go down to the seconds or build candles based on volume. The popular time frames you will see are the 1, 5, 15 minute, 1 hour, 4 hour, daily, and weekly time frames. The longer time frames, the daily, weekly, monthly, are going to help you identify your longer trends that you should be paying attention to, but depending on the time frame that you are trading in your strategy, some of those longer time frames will become irrelevant. For an example, if you're trading a 1 minute chart where it builds a new candle every single minute, does it matter what's happening on the 1 month chart? Hardly. In this scenario, the 5 minute, 15 minute, and 1 hour chart are most relevant. And there can be different things that are happening on each. So you may have a 1 hour chart where the overall trend is going up, but on the 1 minute chart, which is a small blip on the 1 hour chart where it starts to come down a little bit, but on the 1 minute chart, it is much, much more dramatic. So you would think if you just looked at the 1 minute chart that the sky is falling and the stock is going down, but if you look at the 1 hour chart, you see more clearly the bigger picture that, okay, actually it's going up, so this is just a hiccup. It's a small movement in the grand scheme of things. So, and that's what I meant, that's me touching on there are trends within the larger time frame. Downtrends on lower time frames and uptrends on higher time frame charts and vice versa. All right, volatility, another big word that people misuse, misunderstand, don't respect. Volatility is in essence how much a stock moves. I've seen many people and outlets discuss volatility as a bad thing, when in reality, you just need to have a healthy understanding so that you can respect it. We want stocks to move. It's how we make money. In 2018, I recommended Bitcoin to my dad at $4,000. His response that it was too volatile. It hit $65,000 this year. That's my kind of volatility. A stock that is not volatile will not get you to that point. So yes, it does increase your chance of loss. But again, after you learn what I show you, you can put things together to where you can make the case for this really has the chance to go much, much higher because the tide is turning and the environment is right. If it dropped, it dropped from $20,000 to $4,000. At that point, and it had been down for a while, most of the selling is out. Once something's lost 80% that you believe still has a future, it's pretty safe to start making bets that, it may, even though it could half from here, it could go from 4,000 to 2,000. It's unlikely. So again, there's still risk, and that's another conversation for later down the road. But if you think that it could go to 100,000 and that's at 4,000, all of a sudden that risk to reward looks very, very good. This is extremely important if you're considering day trading in that environment. Volatility equates to opportunity. If there's no volatility, there's no opportunity, there's no money to be made. So. Types of trading. Depending on the time frames you are interested in trading, there are certain designations given just to make the distinction a little clearer as you interact with other traders. Scalping. I would consider this trading on the 1 minute chart or less, but it is generally what it sounds like. You're scalping off smaller chunks of profits over many trades. This requires being right, generally much more than you are wrong, and an intense amount of focus. Many are drawn to the get-rich-quick essence this gives off because it appears to be less risk, but for the most part, it is the death of 1,000 cuts, and it is a form of day trading. I wouldn't necessarily recommend it, but there are certain people who obviously are successful in this space and can make a lot of money from it. Obviously, that's why it's a thing. Day trade. By definition, this is a trade that's not carried into the next day, so you have completely closed out any open trades you started that current day before the market closes. The 5-minute chart generally being the point of focus here, and I personally used the 15-minute, 1 hour, and daily charts as context whenever I was day trading. So there's no overnight risk. So this is essentially, the stock market opens at 9:30, you're buying at 10 o'clock, and even if you're trading throughout the day, you're done by the end of the day. You're not holding anything overnight. A swing trade. A swing trade is the opposite of a day trade. So it's where you buy a stock and then hold it for longer than a day. This does carry overnight risk, but in my opinion, offers the most advantages and the highest possible profit potential. And there are statistics that show that actually even though bad things do happen at night, generally what happens is when a stock market closes, or when a stock closes at a certain level, there's oftentimes whenever when it has a positive trend, an uptrend, and you're trading it, you can miss out on a lot of the gains that happen overnight, because the stocks trade here, but then they go overseas, right? As the world turns, we go to bed, another stock market opens. London and then in Asia are the two other biggest ones, and those stocks continue to trade overnight. And so just like here, if lots of people are buying a stock, people over there are going to be buying a stock, and so you'll have prices gap higher and higher overnight. And so actually statistics show that you're better off holding overnight than you are in one day, but there's it's a trade-off there. So when stocks trend, they generally do so for days at a time. In order to capture as much of that move as possible, you need to be in the trade, but there are advantages and disadvantages of each. And for full disclosure, swing trading is my jam. I totally love it. I love the flexibility there, and I really thrive in that space.